4-step method to high performance trading is about bulletproofing your daily routines, your executions, your skill set, your mindset, and your beliefs to execute your edge trading in live time. The 7-step daily routine for high performance traders is about developing your process, your habits, your mindset, your beliefs, your skill set to master the markets. Bulletproof yourself for success and consistency over the long term. The links are in the description box below. Let's get started.
Good day, trader. Stacey Burke from Stacey Burke Trading. We're going to review some of the templates from the week, some of the different instruments, and just hammering home the importance of having a daily process and a daily routine and sticking to that. The purpose of the playbook is to hunt out the same repeating setups on any instrument. And if you're trading one or two specific instruments, having, again, a process and a routine that you can stick to day in and day out, week in and week out, number one, to protect yourself from just randomly, impulsively trying to trade markets, but also targeting opportunities where we have high probability and also asymmetrical risk reward. So that's a concept that I learned from Peter Brandt with classical charting, Edwards and McGee, Schabacker. Peter Brandt is a classical chartist, 40 years in the markets, and using weekly, monthly charts, looking for range expansion opportunities that come out of geometrical patterns, descending triangles, rectangles, for projected range expansions when markets break out. Now, I've taken that information and compiled it into different ideas that I have learned over the years through the School of Hard Knocks to target opportunities where we're looking at a daily range as the projected take profit area. So when we talk about asymmetrical risk reward, you hear me repeat the phrase level to level. So timings, levels, behavior, price. What is the signal, number one? So has a market broken out? Has it given us a first red day signal, a first green day signal, an inside day, whatever that may be? And then the smallest time frame that I'm working from is a daily high of day or low of day level. Now, I keep repeating to traders, we're looking at the higher time frame. So we're targeting a trade setup opportunity on the small time frame based off the higher time frame signal. Now, I've had people take my work and they're convoluting it into other things, and I keep hammering home simplicity. We're looking for trade setups that target level to level, timings, levels, behavior of price. And when we have asymmetrical risk reward, we're going to be risking up top here, whatever instrument this may be. We're going to risk 20 pips, 25 pips. Worst case scenario, maybe it's an index. There's more volatility. You're on a little bit higher time frame, 5 minute, 1 minute. The time frame is irrelevant when you have the setup. It's about the time of day and the level that you're at. Do I have the setup? What time is it? Entry, stop loss, and a take profit level. There is nothing else. So the most important thing is traders need to learn to sit on their hands, because a lot of the other movement that happens throughout the day and during certain times of the session is designed to trap traders, chasing little candle movements. And if we're targeting level to level, there's really only two areas to either be buying or selling. Now, regardless if you're going long or short, the same process applies. Everything else is really just in a trader's head. It's entry, stop loss, and a take profit. That's any type of trade, any type of trading system, any type of trading, philosophy, whatever. It boils down to entry. Where are you entering the market? How are you managing your risk? And where are you taking profits? There is nothing else. So as I emphasize to traders, you create your own experience in the market. People are talking about supply, demand, gaps, sweeps, hunts, soups, runs, arrays, discounts, premiums, all these other things. Excellent. But it still boils down to that simple process right here, because there's only two things a trader can control in any situation: how much they will lose and how much they can win. Now, markets only do three things. They only do three things. They either break out and pull back and continue to trend. We can look at an example of that. So for example, if we look at the Russell from this week, we had the high of week level broken out of on Tuesday. The market broke out, pulled back on Wednesday, and continued to trend on Thursday into Friday, the closing range of the week, before reversing back to that high of week level made on Tuesday, our opening range and initial balance. We emphasize this in the playbook. Page 26, the importance of understanding the Monday's the opening range. Tuesday, day 2, typically expands the range. And in a high percentage of cases in any market, any instrument, once those two extremes are established, one of them will tend to hold. Now that boils back down to what type of template are we in, and do we have a setup? So we just said markets only do 3 things. We just looked at an example of a market that broke out, pulled back, and continued to trend. So we have different instruments that are going to give us different templates. And then the question is in my session, do I actually have a playbook trade setup opportunity? So we can trade any market that we want. We can trade the same market every single day. And I repeat to traders, I'm just looking for the best setups, the money-making setups on any instrument, based on understanding the weekly templates. So different instruments, we have 4 US indexes, we can have different instruments setting up very similar, but one of them may offer us the best setup in the session on the day that we're trading. Then of course, if we break these down into smaller increments on the day, we can identify other opportunities in our session, in our trading window, and then identifying which one will offer us the cleanest setup. So we have day 1, day 2, we can have a day 3 reversal. Any market, any instrument, any session. And resetting, heading into the backside of the week, day 1, day 2, day 3, into Friday, the closing range of the week. And as I mentioned to traders, we can see 2 to 3 different types of situations on a Friday. The market is closing out the week, so we can have trend continuation trades on day 3. We can have markets that are taking profits into the weekend. So we have traders that are long heading into the closing range of the week. They may lock in the money. The market can continue to trend into the new week, but we have traders now that could be profit taking into Friday. We can have traders that are building positions into a Friday that continues to trend. Now the emphasis is on simplifying your process Monday, Tuesday, Wednesday, Thursday, Friday, so that you have a rinse and repeat process that helps you identify the best candidates on the day in the session that you're trading, whether you're trading reversals, whether you're trading trend trades, whether you're just scalping in and out. But it helps you identify the highest probability candidates on the day in the session that you're trading. It doesn't matter what instrument it is. It can be a currency pair. And when we have a new week, a new timing cycle starting, we can use signal days that will help us identify candidates for potentially larger moves. And we talk about front side, back side of a market. And the purpose of that is that if traders are trying to sell a market that's still making higher highs and higher lows, until we get a signal day, we can still have a market that will continue to grind in that direction. And traders are trying to counter trend it because it's up high or it's down low. Meanwhile, all they have to do is do nothing until they get the signal day. So you're looking at different instruments because different instruments may give you different signal days on different days of the week. And we have a first red day signal on the Swiss franc heading into the new week. Now you could be trading any session, but you have an instrument on your watch list if you're trading currencies, for example, or you may are just trading indexes or metals, or maybe you're following the major currency pairs. We have an instrument that has given us a first red day signal. We're closing out the week inside of the high and low of the week levels. Now, you just heard me say that the opening range and initial balance in a high percentage of cases, one of those extremes will tend to hold week in and week out. We have day 1, day 2. We have a market that actually closed in breakout on Tuesday. It closed in breakout on the way to making higher highs and higher lows. Markets only do 3 things. We have a market that is now broken out, closed in breakout. We have Tuesday. Wednesday continues to stay in breakout. And we talked about this in an earlier video. So we now have a market that has 1, 2, and a third day in breakout outside of the high of day level from Friday. So if we go back and just a simple understanding that we have market now on Friday's range, Friday's closing range, a market has broken out. That Friday high low forms a box. You've heard me say repeatedly, price is always in a box. Now we had a higher time frame box, the weekly high-low level. We have a first red day signal in a market that is broken out against higher time frame selling. So coming back just to a simple understanding, we have a market that broke out the previous week and continued to go lower. The new week starts and we auction back up into that breakout. So let's go back to the three things that markets do. They break out, they pull back, continue to trend. We've just looked at a couple of different examples of that. They break out, they fail, and reverse. Now remember, I said the minimum time frame we're targeting is a daily level. The problem is that traders are chasing all the bars back and forth, catching moves, and they're missing the idea that each one of these dotted vertical lines represents a day. But until I have a trade set up, I'm not doing anything. I'm waiting for the market to set up to target the asymmetrical risk-reward 90-10 opportunity where I can't lose. So we use the phrase escalator for the way back up, whether it's on the a market moving higher highs, higher lows, or lower highs, lower lows on the downside. But this is the front side of the move, the escalator up. Repeating, I'm not doing anything. I'm not trying to catch the high up here. I don't even care about that. That could have happened in London or any other session. I'm waiting for the signal day, the daily time frame to give me a signal. I'm not trying to catch the high. Daily signal. This could have continued to go higher and kept going higher and trending. But we have a first red day signal. We have a new timing cycle. You'll also recognize we talk about 3-day setups in the playbook. Thursday has formed the high of week level. We have a box up high now, a box of potentially trapped volume. And this is where we talk about a 3-day setup. A 3-day setup, high of week or low of week levels, and then a 3-session setup when we're looking for that opportunity to present. So we have a 3-day setup that culminates in a 3-session setup. So for me, I'm trading New York. Well, that obviously means Asia, London, New York on the third day of a template that is potentially now setting up for a 90-10 parabolic trade opportunity, targeting asymmetrical risk reward. What does that mean? If I'm selling, I want to sell at the top of the box, the daily level, the weekly level. That offers me the greatest opportunity to capture the maximum amount from a winning trade. I'm not trying to get 1-to-1 or anything else. I want to sell the top of a box in a market that is potentially going to offer me 5, maybe 10-to-1 or even greater on certain instruments when they set up, which we talk about calling that the monkey hammer, because it's going to wipe out an entire week in 3 hours maybe, or even less in some cases. But we're targeting setups that repeat on any instrument. So people say, well, just show me where to get in. But number one, what you need to learn is actually how to identify an instrument that is actually setting up for a potential trade. That's the most important part, is being able to identify the instruments that are setting up for high probability trade candidates, not just putting up some charts and sitting around saying, well, if it does this, I'm going to do that. And what is the setup though, where you're going to be able to make money that rinses and repeats? So we have a 1-hour chart, and in really simple terms, if you understand that the new hour or the end of the hour is when this market is about to take off, you can be on a 1-minute chart, not because you're counting little bars and figuring out how the 1-minute bar is pushing and swinging and gapping, but because the time of day, that time of day understanding on the smallest time frame allows us to position ourselves in a market as it's about to accelerate into that trade setup, which means we're in the money right away. Now remember, we have a market that broke out. We have 3 days of breakout traders in the market. And a really simple concept is that anybody who's trading up top here after the breakout may be getting caught up high. So remember, I said, just think simple. If you want to buy low, I want to buy down here if the market's going up. If I'm selling, I want to sell up here, but I'm not worried about catching the high. I'm quite okay to sell over here after I know this market is now preparing to break down on the backside of the move. We don't want to be selling into the front side. Now you can do that. That could be a nail and bail opportunity in the London or Europe session. Nail and bail because this market is not set up yet to collapse on the higher time frame on the backside of the move. So here's a simple concept. You might have a basket of instruments and you might get one or two great opportunities, for example, on this pair, but you also have other opportunities that have presented on other pairs on different days of the week. It could be the same setup. You could be hunting the same setup on a cross rate pair, on a metal, on the index. But once this market breaks down and accelerates into the move, it wipes out the entire week in 2 days in this particular case, but the large majority in 1 hour. If we just draw this line across, you can see that we've taken out higher level longs in the first hour of that market breaking down. Now, traders that are positioned up top here into the new hour, we're in the New York session, have a chance to scale into a market that is about to accelerate into a large move and not come back. We're not trying to catch the move inside and all these swings back and forth where you can't actually hold on to a market with size. You know, you get in, you get out right away in 20 seconds, or you're positioned and scaling in and the market runs away and you're in the money. And you're holding on to that. You're at break even, you have zero risk, and you can actually follow this market once it breaks down into the close of the day. Now, if you're not trading in Europe or London and this market has already left the station, the number one thing you don't want to do is try and counter trend it in your session just because you think, well, it's already moved low. It's got to go back up. No, it doesn't have to go back up. This market could continue to break down. Now we're on the backside of the move, and this market is continuing to trade lower. And there's no setup. So some traders will say, well, the Swiss franc's down low and it's the low of the week, and they want to try and catch the low, which is completely fine. You can do that. But what setup are you hunting? Are you just trying to buy the low because it's down low and you want to catch that move back into the closing range of the week? Or are you targeting scalable opportunities that rinse and repeat? So 2 or 3 of these opportunities a week on any instrument can significantly compound your trading account. Now that boils down to how you yourself want to trade, what you trade the best, what instruments you're targeting in your basket, and whether or not you get those opportunities in your session. As I said in yesterday's video, making trading a pursuit of pleasure, not me trying to catch moves and make money every day like Jesse Livermore says, treating it like a job to get regular wages. Where is the scalable opportunity where I almost can't lose and in between doing nothing else? Not random impulsive trading, not trying to catch every little zig and zag and soup in the market. Which setups are scalable that I can hunt that show up on any instrument, and I'm not doing anything else but sitting on my hands. There's nothing for me to do until I get a signal day, and then how does price set up into the new timing window, new session, new day? This is a Monday, a great opportunity on a Monday on the backside of a market that has built up volume after breaking down and pumping back up, coiling sideways into the new week, the new timing window, for a first red day collapse that continues to break down into the new week. We can look at any instrument. The important part I want to emphasize is just the process. Markets break out, they pull back, and they continue to trend. They break out, they reverse and fail, or they stay in a trading range, in a range-bound market. But simple understanding is just looking at bigger picture, because remember, daily time frame. This isn't a 1 hour chart, but we're targeting daily setups. That's why signal days from the playbook are so important. Little zigs and zags and all these other things are great, but what is the higher time frame setup? That's what allows me to target asymmetrical risk reward. So if you understand a market on the daily time frame has closed in breakout, we had a first red day signal, new week, new timing cycle. That market is inside of the high and low. It breaks down back into the high of week level. So we now have a breakout pullback. And just similar to what we just saw on the Swiss franc, a market that is breaking down into the high of week level, we have the escalator down, similar to what we just saw, coiling sideways. A first green day signal on Thursday, heading into the new week, the new timing cycle, and an explosive parabolic move that closes in breakout on Monday, day one, back in line with our original breakout from the previous week. Breakout pullback, continuation. Now we said opening range initial balance in a high percentage of cases puts our extremes in place. We have a market that's making higher highs, higher lows into Wednesday, day 3. And we talk about two types of trade opportunities on a day 3. Trend trades or reversal trades. Breakout, coiling sideways, and continuing to trend. Day 1, day 2, day 3 in a market that is already in breakout. Breakout, pullback, continuation. Daily levels. Breakout, pullback, continuation. In a market that continues to make higher lows and higher highs. No evidence yet of a sell setup. We have buy low setup on Monday, day 1 for the explosive continuation trade. Day 1, day 2, and a day 3 continuation trade in the New York session. So I'm just emphasizing simplicity, sitting on your hands. It's not about me catching every little move. There's going to be session nail and bails. But understanding where you're at in that larger template gives traders the confidence to, number one, lock in the money, but also continue to follow a market, and then whether or not we have an opportunity, a 90-10 setup in the session that we're trading and the days of the week template. Day 1, day 2, day 3, reset. Day 1, day 2, day 3, the closing range of the week. But understanding, number one, what you execute the best as a trader will give you confidence on any instrument in any conditions if you understand the setup that you're hunting. And then what time is it? What signal do I have? What level am I at? How is price behaving? And then what we said earlier, a simple model, no matter what setup you have. Entry, stop loss, and take profits. Now, on any given day, any instrument can give us a signal on the day. We've talked about, number one, markets that close and breakout, but also markets that break out on the day. They may offer traders a session trade or a reversal or a nail and bail on the day itself. But also the patience to let a template set up. I repeat this over and over again, just sitting on your hands and doing nothing and keeping track of instruments and whether or not, number one, we have a signal day, and then how does the template evolve? How does it set up? Does it offer you the setup in your session, or has the train already left the station? So we can have day 1, day 2, day 3 reset. We have our high of week, low of week level. Now, once those extremes are in place, as I just said, one of those extremes may tend to hold. Tuesday is our initial balance, our low of week level in the new week. Day 1, day 2, we have a first red day signal. Day 3 blowing off in the direction of the trend. Now, a lot of traders will say, well, how do you know what direction it's going and everything else? Well, I keep things really simple because once the setup is there, like we talk about in the ACB Masterclass, when you align all time frames, there is only one direction that you can trade. And on the larger pump, coil, and dump on Thursday, the third day in a 3-day setup, Tuesday's the low of week level. We had pump, coil, and we're heading into our US window. I just said a moment ago, when the new hour starts, that may be when this move is about to accelerate. These EMAs, I have several traders ask me, what are your EMAs? What are your EMAs? What are your EMAs? It doesn't matter. They're all representing the higher time frame. You can use any combination of EMAs you want. I use this as a simple visual model to represent what I call the coil. What is the coil? It's coiling sideways into the EMAs. Think of it like a bow and arrow. It's pulling back and setting up to explode. We're just above the low of week level. Markets that coil above the low of week level sideways or below the high of week or high of day level sideways are potentially preparing for an explosive move. Now, when I talk about 90-10, I'm talking about a market that is where I'm going to position myself, and it is potentially now preparing to explode or move strongly in that direction. As I said, once you're in these markets, you're in a market that you're in the money right away. I'm not worried about catching a move, zig and zag. Now, there was opportunities earlier in the day, but I'm talking about the New York session. That sideways coil is where traders have the opportunity to position themselves in the market. So learn to tell time. That is your greatest ally, because
knowing that a new hour is about to start is when I'm going to position myself in the market. We already have our thesis of an extreme, a worst case stop loss area in a market that is already breaking down on the backside of a move. If we're inside of this box, I can tighten my risk up even more and be scaling in as it's about to break down. Day 1, day 2, day 3, reset, day 1, day 2, closing in breakout, coiling sideways, and a vertical explosive move for our 3rd hour New York session traders, keeping things simple. Now, the most important part about mastering the templates is knowing what not to do, not just randomly impulsively trading or trying to counter trend something when it has the potential now to move from one side of a range to the other, level to level, whether we're going in the long direction or the short direction, level to level. And then which instrument is offering me the best setup on the day. The markets do the same things every single week. Different setups, different instruments. They do the same thing every week. The trader is the variable. The trader is the variable. They do all kinds of crazy things. They just trade every little zig and zag of something that's moving, and they miss the idea of the higher time frame, the daily signals. Now, one market may offer us one great trade in our session throughout the week. Some traders may get repeating setups on the same instrument in their session. We don't know. What setup are you hunting? And then understanding what not to do is what protects you and keeps you from random, impulsive, self-sabotaging behavior. Now, different traders are hunting different opportunities at different times of the day. And to repeat, the most important thing is knowing exactly what you are hunting when you're heading into your session, but also a couple of simple concepts. If you are entering into a trade, this simple process applies regardless of direction, regardless of setup, regardless of anything else. It's entry, where your mechanism of how are you going to enter the market? What is your setup that tells you to enter into the market, and then managing your risk, placing a stop in the market, and where you're going to take profits. Now, if you don't take profits, or you on the fly change your mind or make different ideas, and you can see where traders that were in the money now are in the major losses or getting stopped out or stopped out at break even. It's a Friday. Understanding I don't hold positions into the weekend or anything else, but there's opportunities on the closing range where markets continue to trade higher, and later in the day we have reversal opportunities for traders who are looking for that move back into higher level longs on Free Cash Friday. If you get a nail and bail, free cash, that's an explosive, fast trade setup at the New York Open, targeting traders who are shorting the market just before the open, the explosive move back to the high of month, and then are coiling sideways. Same process applies. We have a dump, coil, and pump at the New York Open, and a pump, coil, and dump later in the U.S. session, closing out the week. Entry, stop loss, and a measured move range expansion of our upper boundary rectangle for a 200% reversal on Free Cash Friday. Congratulations to the traders who executed these trades. There are only 2 setups on the day, whether it's over the weekly template, dump, coil, and pump, or pump, coil, and dump. And as my friend Steven says, trap and shift. Same thing over and over and over again. Any market, any instrument, doesn't matter what market it is, what setup do you have in your timing window in the session that you're trading. Retraining your brain to simplify everything. Hunting the same setups, the same rinse and repeat 90-10 setups. I'm not reading markets. I'm not counting pushes and bars. What setup do I have? And in between, doing nothing else. Same setup, any instrument. Like Jim Rogers says, I just wait until there is money lying in the corner, and all I have to do is go over there and pick it up. I do nothing in the meantime. So for traders out there who are wanting every day to see some kind of movement, I keep asking the same question. What setup are you hunting? What 90-10 setup are you hunting? And understand this in closing. 2 to 3 scalable opportunities a week can significantly compound your trading account. Trying to catch moves every single day, everywhere, and every zigzag and movement can put traders into psychological conditions where they can end up going on tilt and doing damage, doing things that can cause damage to their trading account. Make trading a pursuit of pleasure. Play this game to win. What setup are you hunting? Build your watch list each day. Which instruments set up in your session? Timings, levels, behavior of price, entry, stop loss, take profit level, and managing yourself in between. Keep things as simple as possible, traders. Target money-making setups. Keep it simple. Have a great weekend, and may the markets go with you.